What's up, traders and investors? It's Trend Trader here. Today I want us to look at the relationship between risk and volatility. I know that there are some people who seems to confuse between these two concepts, risk and volatility. So today I want to sort of clarify the relationship between the two, the way I understand it and the way that it is described in the literature. So we are going to start with risk. So basically, risk is the possibility of a loss. This means that whenever you take an investment, there is that chance that you might lose your invested capital. In the context of the stock market, you can lose your invested capital. So that is what a risk is all about, you losing your invested capital. But since you already know that investing is risky, meaning that there's a possibility of a loss, there are ways that you can mitigate your risk, or at least reduce it to a certain extent, which is why it is always important to know that investing involves risk. Thereby, this makes you, before you take an investment, you think about the risk that is involved, and then you see how you can manage risk. Because in life and in market itself, you can't avoid risk. You will always need to take risk in order to gain something, specifically in the stock market. So now, before you go on an investment, you need to first look at your risk appetite. What are you willing to lose in order to make all the gains that you think that you're going to get from the stock market? So meaning that you have to understand that there is risk, but understanding risk is just half the story. A lot of people, they understand that there is risk involved in the market, but what is more important than understanding risk is actually accepting risk. Let me make an example. If you want to buy shares, let's just pick F.I.R.E. That's everybody's favorite because it's trading at a low price. So if you say you are going to take 1,000 rand and put it in F.I.R.E. So now if you know that there's risk involved with investing and you're accepting that risk, basically you are saying whatever happens, you are at peace with losing that 1,000 rand. So you don't just understand that there is risk that is involved with the investment. You are actually accepting that risk. So now that's what differentiates between some of the consistently profitable trader to the new beginners trader, because understanding risk is just half the story, but accepting risk, that is where the rubber hits the road. So I hope that now you understand that risk is just the possibility of a loss, and investing in stock or in the stock market involves risk, but in life there are many other things that involves risk. Then now let's go to volatility. What is volatility? So basically, volatility is defined as the rate of change. So in the context of the stock market, it's the rate of change in price, so the price of the security. Whether you're investing in shares or you're investing in cryptocurrency, you're buying index, or even if you're investing in property, you're buying the house, how fast the price of that house is going to change. That is volatility. So yes, volatility is the rate of change. Now, here's where there's a confusion. If an asset has higher volatility, it does not necessarily mean that it is more risky. Yes, if you buy an asset or if you invest in an asset that is less volatile, at least you can sleep better at night because you won't be thinking about the high price fluctuation of that asset. So now that makes people to believe that, okay, investing in less volatile asset is less risk. But there's no correlation between risk and volatility. And I will touch on that, why I'm saying that there's no correlation between risk and volatility. And then again, volatility is relative. That is why sometimes we'll hear people in the investing or trading space talking about, if you put your money in a less volatile, it should be less risky, and so on and so forth. But you need to know what you're comparing, so that at the end of the day, you're comparing apples with apples. The other day, we were having a conversation with one of my friends on Twitter. Basically, he said that oil is supposed to be volatile, but now it seems like crypto, or we're just going to stick to Bitcoin. Bitcoin is more volatile. So he made that relative comparison. So in this case, Bitcoin is more volatile than the price of oil. Okay, fine. So we just discussed that. We went even to put in leverage, why sometimes the use of leverage can increase the volatility of an asset. But if you want to buy a house, but you want the value of your house to increase, let's say per year, you would like to see a 10% increase in that value of the house, meaning that the volatility of that house is around 10%. We're not gonna go into deep statistics, we're just gonna use simple numbers. So if you expect your house to rise, the value of your house to rise by 10% in the year, then we can assume that that 10% is the volatility on the price of that property investment. But there's some literature, perhaps there's evidence that suggests that investing in the stock market, the average return is between 8 and 12%. So if we take the middle value, which is 10, so that means that you should expect to get around 10% increase in your investment if you invest in stock. So basically now this comes back to say that volatility does not imply risk, because as we can see between these two different asset classes, the property investment and the stock market investment, both of them, the rate of change in their value is by 10%. So now, where is this notion that says shares are more volatile than property? Because in this example, both of them, they changed by 10%. So now you see that high volatility does not necessarily imply risk. And if you look at these two examples, if you have a list of shares that you have that are increasing by 10% and you have a property investment, if you were to sell them, the shares are more liquid compared to the property. It will be easy to just sell your shares at the click of a button compared to listing your house in the market and finding a buyer. And in the end, you might not even sell the house at the price that you desire. But I just wanted to make that example. So now there is this myth that high volatility implies high risk. No, that is not true. Risk is just, it's there. You can lose your money. Well, there are people who believe that you only lose when you sell. Well, that is their belief. If you are not making money in the market, the opposite of making money is losing money. So if you buy shares and their share price drops, you still have your shares, the number of shares, but the value has decreased. So when we talk about risk in investing in stock, we talk about that possibility of the value of your investment decreasing. Yes, you can continue to hold your shares, and it might be even better if the companies, they still pay dividends, because at least you can console yourself with the income that you are getting there. But even there is a catch. If the share price dropped by 10%, but the company is only paying a dividend with a dividend yield of 4%, basically you are still down 6%. So don't just hold on to stocks because they pay you dividend, whereas the share price is just dropping big, and because you don't want to sell, because that's when you're going to realize the loss. I'm not going to touch on the tax. We've got people who knows tax who can discuss the tax implication thereof. So I'm just gonna move away from the tax discussion. So just a quick reminder, risk is the possibility of a loss. Investing involves a lot of risk. Volatility is the rate of change in price in the stock market context. High volatility does not necessarily imply high risk. And then now if we were to go to the high risk, high reward, that's another issue on its own, but just a quick example. It is also not correct to say that high risk implies high return. As we mentioned with the stock market, if the rate of change is 10%, but in that year the share price drops, because it's easy to make the comparison between, let's say for example, government bonds, and we compare them with stock investing. We say that the government bonds are less risky compared to investing in stock. But there are government bonds that are tracking the inflation. Let's just say, for the sake of this example, the inflation is at 5%, and then the yield or return, let's stick to the return because the yield and it's sort of a bit confusing. The return that you're getting from the government bond is 5.5%. Then there is stock investing on the other side. We know that on average there's that 10% return, or between 8 and 12%. But in year one, the stocks, they just crash, they go down by minus 10%. So basically, in the end, you chose to invest in a risky asset where you lost money, you didn't make money, so there was no return. Whereas the safe asset, which is the government bond, managed to give you 5.5% return, which is higher than the inflation. So now that prompts one to ask the question, is it really necessary to invest in riskier asset because you are chasing higher returns? What are the chances that you are actually going to get those returns? And yeah, I mean, before the emergence of cryptocurrency, stocks were the go-to for riskier asset, higher returns. But now we saw that cryptocurrency, it's much more volatile, and yeah, it brought people a lot of returns. And in the context of us as market participants, whether we are investors or traders, our lifeblood or our lifeline is volatility. If you buy a share today that costs 100 Rand per share, if there is no volatility for the next 12 months, it will mean that the share price will be stuck at 10 Rand. So we didn't make money, we didn't lose money. We just invested in a no volatile security. So we're not going to make money there. What we need is volatility. So if the share price changes by 10%, in January it's 100 Rand per share, by December 31st it's 110 Rand per share. So our value would have increased by 10 Rand, or at least by 10%. So we want that volatility when we're investing, because that's the only way we're going to make money in the market. So you shouldn't fear volatility because you're thinking that volatility implies that it's risk. Without volatility, you're not going to make money. You're not going to lose money in the stock market. The end goal is to make money, but once you understand that there's a risk involved, it will be easy for you to understand and accept that not all your investment are going to make you money. Some of your investment are going to make you money. Some of your investment are going to lose money. But we'll touch on the asymmetric risk to reward on another video. In this video, we just wanted to at least clarify what is risk, what is volatility, why we need volatility in the market, why whenever we buy different assets, we need to look at the risk profile of that asset, and also maybe take into consideration the volatility of that asset. So yeah, that's it for today. If you find value in this video, I will appreciate it if you can click the subscribe button if you haven't subscribed. And also, if you like the content of this channel, please click the like function, because it helps the YouTube algorithm to spread the video so that a lot of people can get access to these videos, or can at least it can show them these videos. And also, if you enjoy the content of this channel and you don't want to miss the future uploads, just click the bell notification so that every time we upload a video, you can see there. So we will see you on the next video.